You know, in the world of investment crowdfunding, something kind of weird is happening. The signals are totally crossed, and it's leaving a lot of people scratching their heads and wondering what on earth is going on. Welcome to The Explainer.
Okay, so let's just get right to it. The big question. Is this market hitting a wall, or is it secretly stronger than ever? The answer, as it turns out, is a little bit of both, and it tells us a really fascinating story about where the smart money is headed these days.
So check this out. If you look at the data from this past July, you see the problem right away. On one hand, the number of new companies looking for funding, it hit a 5-year low. You'd think, okay, the market's in retreat, right? But hold on. At the exact same time, the total amount of money investors committed to campaigns was way up. Fewer deals, but more money. How does that work? That's the paradox.
Now, here's where it gets really interesting. The gap this reveals. Investors pledged over $38 million. But the funded capital, that's the money that actually gets to the companies when a campaign succeeds, was less than half of that. So what does that tell us? It tells us a ton of cash is floating around, but it's only landing in the pockets of a very small, exclusive club of winners.
So that brings us to the big question, right? Who are these winners, and who are the losers in this new landscape? It's really like a tale of two completely different markets playing out at the exact same time. Let's break down who's actually thriving.
You can pretty much sort these winners into two main camps. First up, you've got your rapid risers. These are the deals that just catch fire immediately, you know? They pull in a flood of capital right out of the gate. Then you've got the steady climbers. These are the companies that build momentum over time, showing they have real, durable appeal.
And this is a perfect example of that difference. Rise Robotics, a classic rapid raiser, pulled in a staggering $14 million on its very first crowdfunding round. Wow! On the other side, you have a company like Citizens Coffee, a steady climber now on its fourth round, consistently proving its model and raising nearly $4 million. Both are absolutely winning, just in very different ways.
And listen, this whole winner-take-all thing, it's not just happening with the companies themselves. It's also happening on the platforms where these deals actually live. A few key players are basically becoming the epicenters of this new, selective market.
And wow, look at this. It couldn't be clearer. WeFunder alone captured nearly half of all investment commitments in July. Then you add in Start Engine and Republic, and suddenly you see that just 3 platforms are controlling over 80% of the entire capital flow. That is a massive consolidation of power.
And the original report on this really hits the nail on the head. This isn't just some fun fact for market watchers. It has real-world consequences. It means it's getting much harder for the new guys, new platforms and lesser-known companies to break through all that noise and get noticed.
Okay, so why? Why is all of this happening? What's going on inside the investor's head that's creating a market that's so selective, so top-heavy? Let's get into the psychology behind all these numbers.
You know, it really boils down to one primary force: consumer confidence. You could even call it the market mood. Right now, momentum and perception, they're everything. Investors are backing deals that just feel like winners. Yeah, traditional things like interest rates are still in the mix, but other stuff like inflation and geopolitics, they've kind of faded into the background. It's all about sentiment. So what's the big takeaway here? It's that the average retail investor in this space is, well, they're growing up. They're not just chasing hype anymore. They're becoming way more selective, more disciplined, and more cautious with their money. This isn't a market crash. It's a market maturation. And we've got the proof right here. Even with fewer deals getting funded, the average amount each investor is putting in, the so-called check size, is still incredibly strong at almost $2,700. That tells you something really important. The investors who are participating are doing it with some serious conviction. They're not just taking a flyer, they're making a real bet.
So where are those high-conviction bets going? Overwhelmingly, they're going to established, post-revenue companies. Businesses that already have a proven track record captured almost 2/3 of all the capital. Yeah, the days of funding a cool idea sketched out on a napkin, those are fading fast.
To really see what this more mature market can build, let's zoom in on one specific area that has just been killing it with crowdfunding: financial services. And honestly, I can't think of a better example than this company called Algo. Their journey is just a masterclass in how to use this new, disciplined environment to create some absolutely explosive growth, all thanks to a system called regulation crowdfunding that lets everyday people get in on the action. So picture this. It's 2022. Trade Algo has a product. They're making money, just under $300,000 in revenue. A pretty modest start, but it was that crucial proof that their model actually worked. Okay, so they've got that proof in hand, and they go to the crowd. And the result? Bam! They raise over $1 million. This wasn't just cash. It was powerful market validation from nearly 400 people who truly bought into their vision.
So what do you do with that kind of validation and a fresh $1 million? You scale, and I mean you scale hard. Fast forward to today, and their revenue has just exploded to over $11 million. That is a 38 times increase.
And what about those nearly 400 early believers? Well, the company's valuation has skyrocketed to $375 million. For them, that's a 13 times return on their investment. I mean, this is the incredible potential a mature crowdfunding market can unlock.
And if we zoom out, as amazing as that story is, Trade Algo isn't some weird fluke. The financial services sector as a whole has been using crowdfunding to create this massive economic ripple effect, creating tens of thousands of jobs and generating billions in economic activity.
All right, so after all that, what does this actually mean for the future of funding? Where does this whole paradox, this shrinking yet booming market leave us?
Let's circle all the way back to that first question we asked. Is the crowdfunding market shrinking? No, it's maturing. It's evolving from this wide-open field into a much more focused arena, one where investors are placing bigger, smarter bets on companies that have already proven they can deliver.
And all this leaves us with one final, and I think really crucial question to chew on. As these everyday retail investors become more and more disciplined, more selective, are they building a stronger, more resilient foundation for innovation, or are they just recreating a miniature version of Wall Street with all of its biases towards the safe and the established? The answer to that is going to shape the next decade of startups.